About me, I'm 35 years in Silicon Valley doing all kinds of startups and some with success, some with less success, but overall, very good life. Build a great network and happy life. So that's all that anybody needs to know about me, other than I'm also part of the new venture fund called Inspire Global Ventures, where I'm just an advisor, not the GP. But anyways, let's talk about our panelists here. So first on my left, I'd like to introduce you to Megan Shi. She's representing Waterpoint Capital, based here in New York. She's residing right now in Monaco. And then we have Alexandra Wilkins representing Clerisy. And I will let's start with you,
Can you hand up your mic, because those mics aren't working right now?
They're not
They'll be working in 5 minutes.
Okay, great. So Alexandra, if you could tell us your story.
Sure, I will keep it brief. I am now local to Miami. If anyone's local, one of the many who moved from New York full-time to Miami, but I have Cuban heritage. My mom's Cuban, so always had deep ties to Miami. I am most known professionally for being co-founder of Gilt.com. Maybe some of you have shopped on the site. Hopefully I saved you some money as a shopper. After that, went on to be co-founder of a business called Glam Squad in home beauty services. Then went on to work on 2 startups in AI and machine learning in the apparel space. One we sold to Google, the other we sold to a company called Clerisy, which then sold to Vestiaire Collectif. I spent a few years in corporate America at Allergan, building everything. I was responsible for everything consumer digital. If Allergan doesn't ring a bell, maybe you're familiar with Botox, Juvederm, Cool Sculpting, Skin Medica, Netrel breast implants, and a whole suite of aesthetics-focused brands, drugs, and devices. So I ran everything consumer digital for them and got to build businesses from within and have much more generous budgets than I did as an entrepreneur. Being an entrepreneur is interesting as well. Then in 2020, I partnered with a woman named Lisa Myers, and together we launched a growth equity fund called Clerisy. We are consumer and tech-consumer focused growth equity. So typically Series B stage investments. We look at consumer very broadly, everything from personal care, CPG, healthcare, fintech, health and wellness. We just made a media investment, so very broad-based. We consider ourselves consumer experts. I am the operator in the equation. Lisa, my partner, came from L. Catterton. She was a partner there. Before that, she spent 19 years at Franklin Templeton running their global consumer fund. So we're an investor-operator duo. I am not here to pitch you for money, so don't worry. Our fund is closed, 84 million, but we will go out to raise fund 2 in about 9 to 12 months. So always nice to meet people in advance of when might be relevant, and excited to be here. So thank you. And I should mention, I have a portfolio of about 80 angel investments and investor in many funds, and I've been an advisor in a lot of companies that I'm sure you know and love and potentially have invested in as well.
Hi, I'm Megan Shi. I am, I'm currently based in Monaco, but actually a New Yorker. I've been in New York for over 12 years. My background is on the technology side. I've worked for a number of, well-known tech startups, if you will, back in the day. If you guys remember BlackBerry, I don't know how many of you have seen the movie. Oh, there we go. So BlackBerry, Virgin Mobile, so a lot of it on the mobile technology side, in the earlier days, bringing mobile web, a lot of the mobile solutions, and also internet as well. I was out in Silicon Valley for a number of years before moving to New York, working on a number of different startups, ranging from mobile technology, to some of the fintech firms that I've advised and worked with as well, and dabble a little bit in crypto. But my partner and I, my co-managing partner, who's based out of Toronto, I'm in New York. Our fund is called Waterpoint Lane. It's focused in the ag tech and food tech space. When I tell folks, just given my background, a lot of them are kind of surprised about technology in agriculture. They don't understand a lot of times many of the advancements that we're making, as well as some of the food security challenges that continue to face the world today. It is a lot of the solutions come from working with the technology, and especially AI plays a very large part in it. And so we are an emerging fund manager. We just did our first close in June. We were selected to partake in the VC Lab Founder Institute based out of Silicon Valley. So normally they get over 3,000 firms that apply, that go through the program. Less than 2% graduate, and even fewer do their close. So we were one of the lucky ones that were able to close our fund, as well as, we won also the top closer award. And so we've deployed our capital already. We started with a number of different companies in energy distributed resources, agriculture, regeneration, as well as micro factories and localization for distribution. So very excited to be here today.
Well, thank you very much for the introduction. So I wanted to start with you, Alexandra, talk about your investment strategies, where you get your deal flow, and what is the sweet spot and the stage of the companies that you're investing
in. Okay, sure. So Clerisy, as I mentioned, it's we take more of a private equity mentality, I'd say, than venture. Before, when there was a zero cost of capital environment, we were already in 2019, 2020, when we were putting the fund together, very focused on profitability and helping identify companies that were satisfying and fulfilling consumer problems in a unique way, but that were building structurally profitable businesses. Now, it's great to see more VC firms using the word profitability, because I remember I, as a founder in my early days of Guild, when we were just building, first year 25 million in revenue, second year 170 million in revenue, when we were go. I never heard any of our VCs ever say the word profitability. So it is refreshing to see this shift. So we're looking for businesses, ideally 10 million in revenue or higher. We will look earlier stage, but that's really our sweet spot, that are profitable. They could be break even, but really want to see a healthy path to EBITDA. And we think very carefully about potential strategic exits. For us, we're not looking to invest in companies, clean them up, make them more profitable, make them look prettier, and then sell them to a bigger sponsor. That's not really the objective. We spend a lot of time with strategics to understand what is it that they're looking to acquire and bring into their own portfolios. And that means CPG, strategics, beauty, personal care, media, all the healthcare, all the categories that interest us. The deal flow is the easiest part for us. We're quite networked. Myself as a 3-time founder, an active supporter of founders, especially female founders. I wrote a New York Times bestseller. The deal flow is the easy part, and about 35 of our LPs are founders who've had very relevant exits in the categories that we play. So we get deal flow from them. We get deal flow from our portfolio companies, from friends. I have 23,000 contacts in my phone. I would call myself a super connector. So the deal flow is the easy part. If anything, the hard part is prioritizing time for conversations. We don't want to just have conversations with founders for the sake of it. We're very deliberate. We take a long time for our diligence process. We do so many reference calls, diligence calls, research calls. So we go really deep in the diligence process, which can make us a little slow compared to maybe other investors that pull the trigger quicker. But we think in this environment, which has been interesting for the past year, we think that really research diligence approach will serve us well. And the intention for us is to have a concentrated portfolio, no more than 8 to 10 companies. We've made 5 investments so far, about to announce another exciting one. And well, I can't say too much, but we're excited to announce it shortly. we, especially because I'm an operator, we spend a lot of time with our portfolio companies. I sometimes get an email address for some of our portfolio companies because we're in the weeds, we roll up our sleeves, we help them wherever they need help. We're usually their first call on a good day and a bad day, so that's a lot of calls. And yeah, it's a lot of fun. I love the variety of what we do. As many people are like, oh, do you think you'll go back to operating? And I can't imagine ever doing that. I love the variety and being able to connect experiences that we've seen in companies in one category, in one sector, and apply them to a completely different category, which not that many investors that play at our stage do with the fluency and consumer that we do.
So in terms of the sweet spot of your investment, are you doing the early stage or are you doing the?
So our checks
baby?
are 5 to 10 million into a company, and typically they've been Series B. Sometimes we'll see businesses that have been bootstrapped, so technically not a Series B, but that's been for the most part the sweet spot.
All right, Nathan, tell me, you're still raising your fund, right? For your venture. But you already have invested some money, and so
Yes.
can you tell us a little bit about your portfolio companies that you have?
Yeah, absolutely. So so while we are still raising, we have deployed capital already in 3 companies. So we cover a number of different sectors, and we also, when we look at the portfolio holistically, kind of like what Alexandra was saying, we also take a venture growth equity approach in that, we really kind of look at the profitability and the EBITDA for the companies and not just sort of the earlier stage, riskier investments. So we have one that's on the soil regeneration side. It's called MyLand, and this is a sort of a SaaS-based model for farmers. It helps them with their soil regeneration, which ultimately produces much higher quality produce. So they've been operational in North America, and this is one of the ones that we did earlier on through one of the syndicates when we were doing it through a syndicate structure, and now it's part of our fund. There's another one that's called Peak Power, which is actually a Canadian company based in Toronto. And they're a distributed energy resource company. They're one of the few companies that actually handles multiple assets, meaning that not only is their technology being used, in various things like real estate, but also for other assets such as utility companies and power structures and so forth. And then one of our most recent investments is in a company called Relocalize, which focuses on micro factories. So they basically take out the logistics for localized distribution of produce. So one of the first things that they're focused on right now is ice. Ice, many people don't know, is actually a complex distribution, and it's also a very much monopolized business. I'm sure a lot of you have heard of Arctic ice, which you'll see in a lot of the machines that are kind of everywhere through stadiums and all sorts of structures. They're actually owned by the Carlyle Group. And so this company, Relocalize, is looking to disrupt that industry through their own, microfactories that will allow much more efficient and decarbonization in terms of the logistics.
Great, yeah. Yesterday we had the wonderful, almost a grandson of the founder of all the venture capital, Tim Draper. So he pretty much said anything that I wanted to hear in general about the trends, what's happening and all that, but it doesn't escape me to actually figure out what the trends might be. Just about a year ago or so, if you were to come to the VC meeting and you mentioned that you're going to have an AI company, the point to the door will be very quick, right? But everything had shifted in November as the OpenAI released their product, and by now there's so much money flowing into the Silicon Valley, it's unbelievable. It actually feels like the dot-com area, which we all remember. But my question to you is that with all of the different trends, but let's set aside the AI aspect. Like, what would be what would you say are the current trends in the ventures? I mean, what is it that you really want to invest in, like besides the AI?
So AI aside, in terms of the companies that we've seen, is really about removing a lot of the waste. So food waste is one of the biggest issues that we have right now in a number of the companies that we've been speaking to as part of that circular economy. Food waste has been a recurring problem that a lot of the economies are trying to solve. And you'll see from, for those of you that tuned in to COP28 recently, some of the trends that they've been talking about. Increasingly, food tech and ag tech are a huge part of the global goals for emissions, for reducing emissions, just because of the structure and the way that the way that the process flows. And so where we've seen, aside from AI, but technology overall, a lot of the ways that we've worked with our portfolio companies is from a digital transformation perspective. And in order for them to scale and grow profitably, technology plays a huge part of that. And as part of it, we partner with a number of large technology firms, from Amazon, Google, Microsoft, that are part of them building that infrastructure. And one of the first things that we look for when we do our diligence on these portfolio companies is where they stand in terms of the technology readiness and how they're able to approach the issues that are the challenges that are upcoming and forthcoming. I know within ag, there's been a lot of talk about vertical farming. In many ways, it's been a bit of a failure just because of the immense energy that it utilizes and the immense resources, not so different from Bitcoin mining, unfortunately. But the idea, there's a lot of trends and ideas in ag tech, such as vertical farming, where you think about localized produce, and you're thinking about the Michelin star restaurants with farm to table, and it sounds very glamorous, but it actually creates a lot more issues than it's actually solving, which is why so many of those companies have not done very well.
Great. What about you, Alexandra?
Sure, I would add on to that. I mean, health and wellness, I think, has been a topic for a while. We believe that category is here to stay. We look at humanization of pets, looking for innovations there among pet services. I have to mention the GLP-1s, so Ozempic, Mounjaro, Wegovy. I mean, they're having a massive impact right now on consumers in many ways. So we are looking for innovative, we're not, I'd say, pharma experts. So we're looking for consumer companies that are tapping into and benefiting from this trend that we think is going to be here for a long time and have tremendous impact on the consumer. So very open to conversations related to weight loss alternatives or even impacts that you see in hospitality. One of our portfolio companies is a fintech POS company called Union. It's based in Austin, and it's an inventory management company as well as POS for high volume bars and restaurants. And so even seeing the impacts of the GLP-1s on tabs as people are ordering in hospitality, which is interesting to see. So love following consumer trends. We joke around, we never want to invest in, let's say, the fourth Casper when everyone was talking about another mattress company, another mattress company, another mattress company. We want to invest in the innovator, the leader, the pioneer, who's really early to market, but has already proven out that product market fit. So it's somewhat risk mitigated and is really solving consumer problems in a unique way.
Yeah, I noticed that anything that you do, you don't do the term sheets on the napkins, right? Like in the restaurants, you do a lot of due diligence. Company really has to actually make money, which is fairly unusual in the Silicon Valley environment, right? Because companies get $150 million in plus, and then they will not produce any profit. They don't even have a good business plan. So that's very accurate of actually doing the proper way, as we've said. But on the other hand, from the risk takers like Tim or whoever else, you meet the team and then you buy the idea and then you write on a check. So it's like a little bit different.
Hey, Art, can I get a quick question, Nor?
Hey.
Let
me give you the mic.
Oh, thank you. Appreciate
Alexandra.
it. I couldn't make it. I'm gonna borrow this idea when I do mine. So my question is, consumer seems, there's a lot of digital these days, and consumers move greatly towards the digital realm. Is that something you're interested in, or are you only interested in the material world?
Oh, no, we're very much interested in digital, absolutely. I think, the word omni-channel has been used for a while, so if you talked to me maybe a year and a half ago, I would be saying, oh, omni-channel is not just digital and in-store, but it's also the metaverse, and I have a lot of strong opinions on the metaverse, but that doesn't seem to be so much of a hot topic these days, so I'll exclude the metaverse. But when we're spending time with personal care companies, we like to see their DTC strategy, but we also really think that if you're trying to introduce a new brand, a new behavior to the consumer, partnering with existing retailers, relevant retailers for the category, whether it's prestige or mass, that already have that foot traffic, that already have the consumer paying attention, we think that's critical. We're not that excited about DTC only businesses because it's really tough to attract the consumer these days with the changes in iOS 14. And we tell founders all the time, revenue for the sake of revenue. If you're buying your revenue, that's terrible. We want to see an advantage business model that perhaps has some sort of ambassador network or influencer network or a B2B2C play or an enterprise solution that's giving you an advantage in terms of attracting relevant eyeballs quickly, scalably, cost effectively.
Great. Thank you for explaining to us. This is really valuable. I just want to talk to you a little bit, Nathan, about the fact that you're raising the capital right now, right? And there isn't really a lot of dry powder, quote unquote, in the venture coffers right now to cover all the fintechs that need around B, C, D, and F. So everybody kind of switches and creates this early stage opportunity, writing $1 million checks to 100 companies. That's kind of the trend. But in terms of what you're trying to do right now, you're trying to raise the capital for your company. So tell me a little bit about your journey. Where do you go to find the GPs?
Yeah, so capital raising, as I'm sure everyone here knows, except for those that are the ones giving out capital, is one of the most painful things as part of running any business. And especially in these times, it becomes even more difficult given all the instability and all of the various things that are happening throughout the world. We've had a very interesting journey. We've actually been very lucky in the way that we've very much accelerated very quickly. Talking about the fund and kind of putting everything together, we already had a 2-year track record, which provided some pretty good returns, 46% IRR on our portfolio. And at the beginning of the year, when we talked about kind of putting the fund together, and we were thinking our approach, the way we wanted to build out the fund, it was very much a combination of venture capital and private equity approach. Venture in the sense that we're looking at cutting edge technology companies, innovation, but not so much in the sense of, hoping that out of a bunch of different smaller checks that a few of those would stick and hopefully become a unicorn. That was not our approach. Our approach with our founders, especially given that we are a smaller fund, from a VC perspective, but we have really great relationships with a lot of our founders and portfolio companies. And we're very much taking an active role in terms of guiding them and how we structure the company. And we're working actively with the CEOs to really build out the ecosystem. And in that sense, we look at ourselves as like a very agile fund manager in terms of our approach, but also with the institutional credibility that we have, which we get from, our experience, our network within our strategic partners. So we partner closely with a number of large private equity firms, because we're always thinking about the exit. It's the exit which brings the big valuations and ultimately provides the largest returns to our clients. So in my previous role as the founder of Amazon Web Services Private Equity Group, I worked extensively with companies like Warburg, Blackstone, kind of with the deal partners, as well as with a lot of the executives, the CXOs, in terms of their exit strategies. I saw firsthand and I participated directly, just seeing how quickly a lot of the technology innovation, the digital transformation really accelerated the scalability of these companies. Because at the end of the day, that's really where you're going to get the 5x returns for these companies. And so we really work closely with, we kind of pride ourselves on our technology prowess. So we're working, as I mentioned before, with the companies like Google, Amazon to help build out the appropriate technology platforms. And then on the other end as well, with the larger private equity firms, Also corporate buyers as well. There's a number of different ways to exit, of course, whether it's an IPO or it's with a sale. There's a number of ways that we kind of shepherd our companies through that. We actually have a company that, probably in the next little while, obviously I can't give the exact timing, that will be, sort of on that path. And so, everything that we've done has been very, very accelerated, and we're able to do that because of the resources that we have. On our investment committee as well, we do realize we are fund one. It's always the chicken and the egg problem. Everyone's always like, hey, you're an emerging fund manager, call us in like 5 years when you're on, Alexandra and I were joking about this earlier, when you're on fund 3, fund 4, we're like, geez, how many funds does it take before you stop being an emerging fund manager? And so it's, because of that, we do have very seasoned investment managers that are part of our board and part of our investment committees as well. One of the gentlemen that we have, he used to run the University of California endowment. Another one is also also runs a large multi-billion dollar family office as well. And so we have a lot of the areas and the expertise to provide that stability. So in that sense, the reason we won, top closer award, which by the way, VC-Lab is affiliated with Mr. Tim Draper as well. So we've seen him come in and speak and encourage us every now and then. We're able to kind of do that at such an accelerated rate because we kind of bring in all of those different factors together. So, but nevertheless, it's still difficult. It's always challenging when you're, out there kind of telling your story, talking about the progress so far. So it's always a bit challenging in that sense.
And then how much more do you have to close that first one?
Yeah, so we're raising a $50 million fund. Assuming these institutional investors come through, we're looking to get it closed in the next couple of months. So it should be.
And what's the size of the ticket, like roughly?
Minimums, depending on the folks, like usually, $1 million is minimum size, but we'll look at it upon an individual basis and with various investors. So.
Great. Well, thanks.
Thank you.
Alexandra, a quick question for you on like a geospace, like everything that you do, you're taking into consideration like a global position, or that's more like a United States.
Fun questions. So we have no geographic mandate. Lisa, my partner, she's been a global investor her whole careers, and I speak 5 languages. I'm very comfortable in throughout Europe, Latin America. Lisa's quite connected in Asia and the Middle East and Europe. So our experience, I think, plays well to either bringing a US company internationally. We see lots of those opportunities, or sometimes, for example, our 3rd investment is a UK-based company called CleanCo in the non-alc category. It's UK headquartered. We put a CEO in place based in New York, and they're quite established in the UK, have a well-known celebrity founder in the UK, but the US is the prize in terms of building the business. So we've been quite involved in helping grow the US footprint. So it's not, if any of you want an alternative to tequila, rum, vodka, gin, check out CleanCo because it's clean, so non-alc tequila, rum, vodka, gin, whiskey as well. So that's been a fun investment, but it involves education of the consumer, more education than we probably realized. But so we would invest in companies where we feel our networks are strong. We would invest in countries where our networks are strong. So not a country where we don't think we can add value.
So I have a quick follow-up questions. What 5 languages are you speaking?
Oh, the Romance languages, so Spanish, Portuguese, French, Italian, and English.
Well, very good. What about you?
I only speak 3. So Mandarin, French, and English.
So we're buddies. Me too.
I should say also our LP base, most of our money is actually foreign. So the majority of the capital, over 84 million, is international. So that's helpful too.
Good. So what about you in positioning things in global basis? I know that you're in Europe right now trying to do the ArcTech So is that your focus or is it Canada or United States? Where are you going?
Yeah, absolutely. So our current focus is in North America. We are based out of Toronto. Officially, the fund one is domiciled out of Toronto, Canada. We're always thinking about our future subsequent funds, and as part of that expansion, that's why I am in Europe as well, looking at other parts of the world. So our portfolio companies, North America, but we have been speaking to a number of different areas as well. There's a lot going on in Israel in terms of ag tech. Also India is one of the areas that we've been looking into a little bit. And of course, throughout Europe, the Netherlands has a lot of interesting things that are happening. From an LP perspective, our LPs are global, so anywhere, anywhere globally is where we can, where we can work with our LPs.
Okay, great. Wait, Alexandra, I have another question for you. So your companies, portfolio companies, are kind of like your children, right? So name your favorite child.
I can't do that, but I have two real children and there's some days that one might be easier than the other. I have teenagers and the same thing applies to the portfolio, you often find I find myself spending the most amount of time with the business that needs the most amount of help in that moment. So Union, the company I mentioned based in Austin, I don't hear from them as often, so they're the easy ones.
So is this just like in natural life, right? Because I pay the most attention to the troubled children, right? So but what about you? What do you think about any one of the companies that you guys invested in already? Where's your heart?
Okay, so I'm the exact opposite, maybe because I don't have any children, and so I go for the one that's kind of the star and more. Although I hope this is being recorded, I don't want the other portfolio companies to hear. The one that we recently invested in, Relocalize, is kind of the superstar. Hopefully, maybe even unicorn down the road. They're doing extremely well. Very large strategic clients that we've already seen. In terms of their revenues, extremely strong, and just really going towards a very great trajectory in a very short period of time. So very interesting the way that they're scaling as well. So that would probably be my favorite.
All right.
Wait, and I have to just say something, because I didn't mean it to sound as though any of the companies are troubled. It's more like I get super operationally involved in hiring, for example. So I have, for our portfolios, probably personally hired 30 people across the portfolio, and as you all know, to hire one person, how many people are you interviewing to hire that person? So get very in the trenches when businesses are hiring, when they're launching new products, when they need help with marketing and PR. Sometimes I jump in and do the marketing and PR for the funds, or for the portfolio companies. So I didn't mean to make it sound troubled. It's more like, where is there a hole that I can jump in and plug it until we find somebody in the chair to be permanent.
Arthur, we got 5 minutes to be open to the audience.
Yeah, and like sure, I was going to ask about the future of 2024, like the trends, but yes, please open the mic.
Are there questions for the audience, from the audience here, or?
Giovanni, you don't have a question? You always have a question, please.
He's a shy guy.
What is the future of 2024?
I'm going with those. What is the future for 2024?
That's a great question.
How about water? Are you looking at water as a?
Let me give you the mic. Record properly.
So I got a Philadelphia accent. I put a D in there. So water. Are you looking at any projects involving water, and maybe projects by companies that are working in water, particularly in terms of farming and things of that nature?
Yeah, absolutely. Actually, one of the portfolio companies we've been looking at for a little while now is very much focused on water efficiency. And they've been working, so as probably a lot of vineyards use up just an incredible amount of water, and the amount of water that's wasted is just absolutely insane. And so, what's really interesting about this company is the way that they're deploying the water efficiency metrics, the way they're measuring the KPIs, and the way that they're utilizing technology to monitor the waste and how to mitigate that as well. And so it's actually a very young company run by some, very young founders. And, we looked at their business model. They've already signed some pretty large contracts with very large, some very large distributors, and in the way that they're approaching the technology as well. Because that's what we always look for. Their distributed computing model is actually quite interesting. We've been in conversations with some of our large technology partners. They're quite interested in it as well. And so that's one of the portfolio companies we're looking at right now. Water efficiency is actually more detrimental, I would say, in terms of an issue these days, more so than even food, because obviously without water, kind of spreads out to everything else. It's sort of the bottom layer, the platform, if you will. So that's one of the biggest challenges that we would hope to be able to solve.
So not to the water question, more to the 2024 question. One thing that we've seen a change in over the past year, so when we would put together term sheets from our very first term sheet, we invested in a company called Dormify, everything related to getting your child ready for college life and potentially tweens and teens at home before they go to college. But we started putting structure into our term sheets early on in our Clerisy story. And there were some deals in, let's say, 2021, 2022, where we put heavy structure and the founders were like, I want clean term sheet. I want more VC style, no structure. And we said, that's fine, that these are the terms we'd invest, and we were totally fine losing out on an investment that way. Now we have found that founders are expecting structure, they're expecting a preference stack. We usually structure warrants because we invest so much time into our portfolio companies. We're not expecting cash fees like private equity firms charge, but we expect warrants and upside for the time that we invest and haven't had pushback in terms of our portfolio. So it'll be interesting if 2024, I'm not an economist, so can't predict the future, but I think that we'll probably continue to see structure, at least in the first half. And founders, I'm most of my friends, many of my friends are founders, so I'm very I hear day to day their woes of how hard it is for founders to raise money at all stages. It's very, I tell all my founder friends, like, hold on to that cash, preserve every dollar. And I warn them when they're getting ready to fundraise, just be ready for a down round, be prepared for all these things, which is good in terms of my investor role that I play, but I do feel bad for a lot of founders that have put in their blood, sweat, and tears, and finding in some cases common to get really squashed.
Well, thanks so much. I think that we're running up against the clock here, and I'm trying to fix the last panel is Daniel, so he can go and catch the first party. And pleasure meeting you both, and it was a wonderful panel. So thank you very much. And then,
You're right.